The broadcast is now starting. All attendees are in listen-only mode.
Okay, welcome to everyone participating in this webinar. I'm Reed Kramer, Director of the Asset Building Program at the New America Foundation. And we're breaking a bit of new ground here in a couple of ways. First, very excited to engage in the webinar world. It's kind of new to me, but looking forward to the potential of convening a large group of geographically diverse people to share information and to generate a constructive dialogue. And second, I'm very pleased to shine some light on the growing body of work and practice focused on shared equity home ownership, and also to explore the connections between this and asset building objectives. With that, welcome to our session. The New America Foundation is pleased to sponsor the convening along with the Center for Housing Policy and NCB Capital Impact and the Annie E. Casey Foundation. And before introducing our panelists and reviewing a couple of ground rules, I do want to offer a little bit of context. Despite the recent financial crisis, I actually strongly believe that there's going to continue to be interest among policymakers in homeownership policies and programs for low-income and moderate-income families. I mean, I think clearly a number of things are going to change. There's going to be tighter credit. There's going to be a more scrutinized home buying process, and certainly more attention is going to be given to the terms of mortgages offered. But there's also going to be a greater importance placed on savings and down payments. And right now, attention is being given to streamlining the anti-foreclosure efforts and revisions to the housing finance system, and those are going to continue. But I think going forward, the challenge will be to craft a more responsive and responsible housing policy. The foreclosure crisis might have weakened some political support for home ownership, especially for lower income families, but this is probably exactly the right moment where we should be looking at innovative strategies to promote responsible home ownership. And among other things, this should include a consideration of alternative ownership strategies, and that's where shared equity home ownership comes in. It's a promising approach. It has the potential to mitigate risks and provide an attractive balance of affordability, access, and the opportunity to build up home equity. So it has really a lot of potential to create this viable path to meet the needs of families that are really aspiring to own their own homes. And this is still going to be an important pathway because for many families it represents a way to access stability, community, and long-term wealth-building opportunities. So this work's been modeled in communities across the country. I think it's ready for prime time, and that's why we're here today. Local decision makers should be giving a long look at the potential of shared equity programs. And even though conditions are going to vary across the country, there's a lot that can be learned from past practices. So in the webinar today, we're going to hear from a set of experts to really help us in this process. And they're going to include, in the order they'll speak, Jeff LaBelle, who's Executive Director of the Center for Housing Policy, Rick Jacobus, Director of the Shared Equity Homeownership Initiative at NCB Capital Impact, and Jeff Corey, who's the Executive Director of Northern Communities Land Trust, which is up in Duluth, Minnesota. And before I turn over the screen and audio to Jeff LaBelle, just a couple of the ground rules. We can't hear you, but you should be able to hear the panelists and hear us and follow their presentations on your desktop screen. You can certainly enter remarks and questions that you hope the panelists can address. And if you're having technical issues, you can also send in a comment through the console box right there on your desktop. So you should be seeing that. There's a bunch of buttons I think you can play around with. There's good information there. But ultimately, you'll be listening to the panelists and be able to send in questions that you'd like the panelists to address. They'll get to as many as possible, but also I just want to say that these are real experts and resources that you could use. Track them down afterwards. There's a number of resources on the web that I invite you to track down as well. For example, Rick and John Davis did a paper for that New America published that's on our website at newamerica.net. It's called The Asset Building Potential of Shared Equity Homeownership. It's an excellent paper with some real valuable data. And this is also being recorded, and it'll be archived and available. So if you enjoy it today, you can tell your friends, and even if you didn't, you can tell your friends to track it down and get some of this information. So that's the opening, and let's keep it going here, and I'm going to turn it over to Jeff Lubell, our first panelist. Jeff.
Thank you, Reed. Jeff Lubell with the Center for Housing Policy. And I'm delighted to see so many of you listening and open to learning more about shared equity homeownership. This has been a program that has been piloted in many communities and has not yet gone to scale. And one of the big questions that we all have is whether there might be an opportunity now that we are in this situation of having a crisis essentially in the homeownership world to take it to scale and bring it to many more families. So I'm going to walk through a very basic PowerPoint that provides some introductions to the concept, a little bit more on the framing that Reed started so well. I'll then turn it over to Rick Jacobus, who will summarize some of the results for asset building of one of the programs that has been evaluated in Vermont, and then to Jeff Corey, who will further talk about the experiences with this program in Duluth. So let's see if this works here. We should all be looking hopefully at a screen, homeownership at a crossroads. And really, I don't need to, this is something we all know, that we are in the midst of one of the most severe housing crises in many years. It's a crisis that started with the subprime loans, has extended into prime loans, led to foreclosures that have really highlighted the downsides of the traditional homeownership model. All of a sudden, people are learning that you can not only make money through homeownership, you can also lose quite a bit of money, and it is something that is adversely impacting many families and, of course, adversely impacting many communities. And so we are right, I think, to be taking a second look at it and asking whether we might want to have a more balanced housing policy, for example, that features rental housing as a strong alternative to homeownership. We also think, however, that this is an opportunity to introduce some new ideas and to try to take a look at new directions. And in particular, we are very much interested in whether a safer model for affordable homeownership might be available. Now, the idea, just to be very clear here, we're not talking about replacing the private market for mortgages. I mean, that's going to always be there. It needs to be strong. It needs to be effective. There is a lot going on right now trying to think about the future of the GSEs, Fannie and Freddie, and what's their role. And none of this is designed to replace that. But it's just asking whether, for a particular subset of the market, people whose incomes are too low to afford conventional homeownership, and for whom we discovered that mortgage innovations such as subprime mortgages were not always the best route to ownership. Might there be a safer model that would have a lower risk of foreclosure, lower risk of equity lost, but would still leverage the private market so that a small amount of down payment could be leveraged significantly and also produce strong asset building results? So we do have a model out there called shared equity homeownership. This is a somewhat confusing title for some people, in part because it is essentially an umbrella title that describes a range of different interventions that have all grown up separately and have a somewhat different history. But they all do share a basic model, which is that a deep subsidy is used to bring homeownership from a level that would not be affordable to the target population to a level that is affordable to the target population. That subsidy is often a direct subsidy in the form of cash for a second mortgage or for an underlying construction loan, but it's sometimes also an indirect subsidy. So inclusionary zoning, for example, can be used to create a pipeline of homes that start out at prices that are well below the market. So the second feature is a set of resale price restrictions that help to ensure that that housing stays affordable over time. So this is a home, whether it's multifamily or single family, this is a home that is made affordable initially and kept affordable over time through limitations of the price at which the home may be sold and the population to whom it may be sold. And then there's a series of monitoring activities that are designed to make sure that that home stays affordable over time and that the resale restrictions are enforced. The number of different applications of this model, and many of you may be more familiar with these terms than with the umbrella category shared equity home ownership. They're community land trusts, which tend to be fairly small, very locally driven models, often have a somewhat complex structure of land where the land trust owns the land and the individuals buy the improvements on the land. There are deed restrictions that are enforced by often by localities, and then there are limited equity cooperatives, which are much like a regular cooperative, except there are limitations on the price at which you can sell your share. And all of these models, by and large, share a feature, which is that they try to balance the goals of long-term affordability with the goals of individual asset building. And they do that essentially by sharing in the home price appreciation that occurs over time. And here are three of the common models. One is basically to do an appraisal at the time of initial sale and at the time of resale and allow the family to retain a certain portion of that appreciation and otherwise keep the home, use the rest of the appreciation basically to keep the home price lower. And I'll go through an example of how that might work. A second interesting model is to tie resale prices to the change in income. So if income goes up by 10%, you can sell your home for 10% more. And what that does is essentially ensure that the home remains affordable to the same income level, roughly, subject only to changes in other variables like changes in interest rates. And the final model is one that actually uses a more sophisticated calculation to be double and triple sure that that home is affordable to the next target buyer. There are advantages and disadvantages to all of these models, but they are all essentially approaches that ensure that the families who are buying these homes have some opportunity to build wealth. So here's an example of how that might work. Make sure, there we go. So I'm going to walk through this very quickly. You can scan it on your screen, but basically, let's assume that you buy a home for $200,000, and we apply the market value for the home at time of purchase is $200,000. We apply a $50,000 subsidy, which would come from public sources typically, to bring the price down to $150,000. And let's say that's affordable to a family at the target income range. In this example, the family puts down $10,000, which is 5% of the market value of the home, and takes out a regular 30-year fixed mortgage for $140,000. So this is very much like buying a $150,000 house, except in this particular case, there would be no $150,000 homes that the family can afford. So they're actually able to attain home ownership in a place where they might not otherwise have been able to do so. Now, in this particular model, the resale price of the home is tied to the changes in incomes. So in this case, incomes have gone up after 5 years by 15% at 3% a year. And so a target family can afford a home valued at $172,500. However, home prices have gone up 25%, 5% a year in this market. And so the market value of that home is now $250,000. So there's this greater gap. And if we were trying to make that same home affordable to a new buyer, we would actually need more subsidy than the $50,000 at the second point in time. But in this particular example, because of the resale restriction, the home is going to be purchased for $172,500, which is affordable at roughly the same level that you started. The family sells the home for that amount. We've assumed transaction costs that are somewhat below what you would pay for a conventional realtor, because in many cases these homes are sold to individuals that have applied to the local land trust or the local resale program, and therefore you don't need to go through a traditional realtor always. And in other cases, realtors agree to accept lower commissions. But in any event, what happens is that the family has made essentially $17,500 in home price appreciation, but also recovered $10,000 in equity through the pay down of their principal in their mortgage. We should remember, I think, from an asset building perspective, that one of the main asset building outcomes of traditional homeownership, and is also true here, is the principal that you pay down, the forced savings that comes with a fixed mortgage. So in this case, the family put down $10,000 and actually walks away with $37,500 for a net gain of $27,500. So I'm trying to go to the next slide and not quite there yet. Apologies. I'm not able to go to the next slide, guys. Let me try to make this work here. Okay, I see. Ryan, do you have any ideas? I've lost my cursor. Okay. I'm going to suggest to Ryan that maybe, no, my computer's not frozen, but, okay, I got to the next screen. My apologies. This technology is still a little new for us, but now I see nothing. But hopefully you all can see it. So basically, I'm at the point in my presentation where I'm going to talk about the benefits of shared equity homeownership. And one of those benefits is that it ensures both current and future affordability, so that home is affordable at the very beginning, but also affordable to individuals over time. Second, this is a model of homeownership that poses a lower risk to the home buyer. And the reason is that that the family is buying the home at a level that is well below the market level. And so they're able to weather declines in the markets that would otherwise cause families to lose money. But if you buy for $50,000 below market and the market stays stagnant or goes down, you may still be able to sell your house and actually gain your full expected value. And also, because the home is affordable at the outset, that also helps to ensure that you have a lower risk of foreclosures. And there's actually been some research that suggests that the foreclosure rate among community land trust homes is substantially below the foreclosure risk for other homes, particularly other affordable homes. Another piece, of course, is that there's an opportunity for the individual to generate a very substantial return on their initial investment. And we're going to get to some information from a study that Rick Jacobus and John Davis did up in Vermont. And this is not just something that's limited to the individual. The community also benefits. So, for example, let's say we're doing a transit-oriented development, and we want to make sure that there's some housing that's affordable to low and moderate income families within that context. Yes, we can and should do rental, but it might also be useful to have this other tenure option, an ownership option that would be affordable to a moderate income family who might not otherwise be able to afford to live there. And finally, from a subsidy preservation standpoint, from the standpoint of the individual and the community, this is a model that helps to ensure that the buying power of that subsidy is preserved over time. So that in a nutshell is the basic initial overview of shared equity homeownership. And I am now going to turn over to Rick Jacobus, who's going to walk us through some of the additional benefits.
Great. Thank you, Jeff. Let me see if I can advance. I'm going to try to step back just a little bit and talk about sort of the problem that we're trying to address. In the past, we've thought about this kind of home ownership really in the context of housing policy exclusively. But even before the foreclosure crisis, but even more so since then, there's been this concern about home ownership in general, and particularly about the role that home ownership plays in creating and perpetuating asset inequality in America. And what you see here is we have, as a result of billions of dollars of annual spending, we have created a society with a very high rate of home ownership, but a very uneven one. White families, more than 70% of them own their own homes, but among African American and Hispanic families, it's less than 50%. And this is sort of the legacy of a long-term set of discriminatory policies in the housing market. But but we've done a lot to eliminate some of the fair housing issues and the mortgage lending issues that have created this problem. But as you see here, the problem hasn't gone away. It's not taking care of itself. And part of the reason is that in addition to assets being sort of a key outcome of homeownership, homeownership is the primary way that middle-income families have built wealth and have accumulated assets in this country. But at the same time, assets have become the primary barrier to homeownership. And so we have a self-perpetuating cycle where the previous generation didn't have access to homeownership, didn't build wealth, and then as a result, Jeff, oh, there we go. Then as a result, we have a harder time for people in this generation to access homeownership. So we've got really good research that consistently shows that people who are renters, who are trying to buy a house, some renters don't want to buy a house, but many, many, many do. And among those who do, they face multiple barriers. One of those barriers is people don't have enough income to afford the monthly payments, and another is that people don't have enough savings to make a down payment, and the two are interrelated. But you see here, only 2% of renters who are prevented from buying are have enough savings. So everyone else lacks the savings necessary. And a sizable percentage of renters have enough income to afford homeownership but don't have the savings and therefore can't access it. And what that means just in terms of strategy or policy is that our current programs where we're trying to promote homeownership have in the past focused almost exclusively on overcoming income barriers and overcoming credit barriers and have paid very little attention to wealth as a reason that people are not accessing homeownership. And so the Census Bureau did this really, I think, extremely interesting study where they said among renters right now, they looked at everyone's finances. They have pretty good data at the Census Bureau about people's household income, et cetera. And they said who could actually afford to buy a house. And they made some assumptions. And they said about 7.6% of renters could, if they chose to, buy a house with current mortgage conditions and the prices in their area. And then they looked at what are some interventions that people use to try to make homeownership attainable to families that otherwise couldn't buy. And one of the most common is mortgage interest rate subsidies. So we have state housing finance agencies that use tax-exempt bonds to make lower interest rate mortgages available. And the Census Bureau said, well, if we make those mortgages 3 percentage points lower, so 3 percentage points below the market rate, instead of 6%, it's 3%. The Census Bureau found only 8.3% of renters could actually afford to buy. So that's a less than 1%, less than 1 percentage point increase in the number of renters that could buy a house. So very, very small impact for a very expensive program. And the reason is because that doesn't address the wealth barrier. Only a very small fraction of people have enough savings, so they couldn't take advantage of that interest rate subsidy. So then the sort of obvious alternative is what we saw recently, what I think you don't see so much anymore today, is loans where there's no down payment requirement. If savings is the problem and people can't get into homeownership because they don't have enough, what if we just don't require it? Well, that only increases the percentage of renters who can afford to buy to 9.2, so still less than 2 percentage point increase. And the reason there is, again, that the wealth barrier, well, we have people with both wealth barriers and income barriers, and when we have a no down payment loan, all that does is it shifts the problem from one barrier to the other. So people who didn't have enough savings, now they can get a mortgage, but they have to get a larger mortgage because they didn't have a down payment. And so their monthly costs went up higher, and they've borrowed more money. So the last alternative that the Census Bureau looked at was, what if a family received $10,000 in purchase assistance? And with that, if they went through those families and they said, if everyone had access to that kind of assistance, 19.5% of renters could afford to buy. So a dramatic increase in the share, the scope of homeownership in America, a dramatic increase in who could actually access homeownership. And the thing that's striking here is that this kind of purchase assistance is widely available right now in the form of family assistance. Many home buyers receive help from their family when they buy a house. But there's a huge difference, a huge discrepancy in who gets what kind of assistance from their families. A third of white first-time home buyers get financial assistance from their families when they buy a house, but only 6% of African-American first-time home buyers get any assistance, and they get, on average, much less assistance. And so this is how we have this self-perpetuating cycle. The alternative is to develop a public policy that makes this kind of purchase assistance available to first-time home buyers and targets it to people who need it. And so shared equity homeownership is really, in a way, a strategy for making that kind of investment palatable and sustainable over time. And what we do is we make a significant amount of purchase assistance available to buy down the cost of homeownership, but then we preserve that and we structure it as an investment rather than a gift. And some people do this in their families as well, but we say we're going to expect the public money to grow over time and to realize a share of the market appreciation so that we can pass the benefit on to future families. So the question then is, in order to make that sustainability work, in order to preserve affordability, if we have to limit people's asset building, we have to limit how much appreciation each homeowner realizes, are we sort of shooting ourselves in the foot? What's the point of homeownership if people aren't building wealth? And I think there are a lot of good answers to that explain why people still will want homeownership and benefit from homeownership even if they build no assets. But what we're finding, somewhat surprisingly, is that these programs generate really significant assets for people even when we preserve affordability. And so we are lucky enough to have a great set of data thanks to the people at the Champlain Housing Trust, which is in and around Burlington, Vermont. And they said, well, we're building these homes and we're selling them to people. Why don't we actually track how well it does, the program does, in terms of a number of factors, but included in there is affordability, is asset building. And so the slide is not advancing. Okay, so the Champlain Housing Trust is a nonprofit in Burlington, Vermont. Since 1984, they've built 424 homes, and they've sold them, almost all of them, to low-income buyers earning less than 80% of median income. And what they did is they just followed up with their homeowners who had sold, and they said, what happened to people after they sold? Where did they go? How much did they get when they sold? What were the outcomes? They issued a report, which you can find on their website, that documents outcomes, a huge range of outcomes. The report that Reed mentioned before that my business partner and I wrote for New America focuses, just sort of drills in on the asset building outcomes of their study. Jeff, I'm going to ask you if you can advance the slides for me because there's too much delay. So they have resold, at the time of the study they did 205 homes. They did exit interviews with each of the homeowners. Next slide, please. And what I'm going to do is very quickly run through the results. So one of the compelling results is that their homes became slightly more affordable. They use a appraisal-based resale formula that Jeff mentioned before, which is the homeowners receive 25% of the change in the market value of their homes. And their market went up in Burlington, but not quite that fast, so their homes got a little bit more affordable. So the second and third generation of homeowners were able to earn slightly lower incomes. Next slide. But they did that at the same time that they offered the homeowners pretty significant wealth building opportunities. Over this period of time, the average homeowner invested $2,300, which is both their down payment and their closing costs. And at the time of resale, they received almost $8,000 in appreciation on average. But you'll see that that average has gone up over time. And so homeowners who sold in the recent years received $20,000, $25,000, $30,000, as much as $40,000 or $50,000 in appreciation. Over the whole period, the average homeowner received a 25% annual rate of return on their initial investment, which is their down payment and their closing costs. And that's significantly better than these families would have done if they'd invested in the stock market or any other opportunity that they might have accessed. But at the same time, they paid down their mortgages, and they received credit for capital improvements that they made to their homes. And altogether, they received an average of $13,000 of equity at resale. And so is that a lot of money? It's sort of hard to say. One way to measure the impact of that is in terms of what we call the asset poverty level. And the asset poverty level is a sort of simple, maybe too simple measure of asset challenges that people might face due to lack of savings. And it's you're considered to be in asset poverty if your savings are not enough that you could live at the poverty level for 3 months. So the poverty level is a certain income level, and it changes each year. And so what we did is we looked at each of these families at the time that they purchased their home, what was the asset poverty level, how much money was it, and how much was their initial investment in their Champlain Housing Trust home. And we found that on average, their investment represented 58% of the asset poverty level. So many of them had some additional savings, but I think it's relatively safe to assume that most of the home buyers invested most of their cash savings to buy their limited house or limited equity house. But at the time of sale, their investment had grown to represent an average of 284% of the asset poverty level. So and for nearly all of the homeowners, their equity at the time of sale was greater than 100% of the asset poverty level at the time that they sold. And so what we see is the program offered people an incredibly predictable and an incredibly reliable path out of asset poverty. This is striking because other data that we have shows that across the country, people who don't participate in a program, 70% of the families that are in asset poverty at a given point are still in asset poverty 5 years later. And these homeowners 5 years later were almost all out of asset poverty. So that's a compelling result. Just a few other quick things. They had a few foreclosures. They had a total of 629 buyers. 9 ended up in foreclosure, which is an incredibly small rate of foreclosure. The recent data, this is consistent with the experience of other community land trusts across the country. The Community Land Trust Network is just published a study this week on last year's data where they found that the foreclosure rate among land trusts was 8 times below the national average. And that's because people could afford their houses and they had support. But what we know is that many low-income home buyers, particularly low-income first-time home buyers, end up returning to renting, partly because of foreclosure, but also just because they can't sustain home ownership and they choose to sell their house, or they have a short sale or some other experience. And some studies suggest that as many as half of these buyers end up renters again within 5 years. But in the Champlain Housing Trust data, at least 90% of the homeowners were still homeowners 5 years later. So it's a much more stable form of home ownership than the traditional home ownership for low-income families. And perhaps the most striking result from Burlington was that the vast majority of the sellers of these shared equity homes moved on to market rate home ownership. So 67% of the families, when they moved, purchased single-family homes that had no public subsidy in them. Another 5.7% purchased another CHT shared equity home, but more than 70% of the families moved on to another home ownership opportunity. And so the question is, how was that possible? If we limited how much appreciation they were going to realize, and they only got 25% of the change in the market, how were they able to catch up with the market? And the math is slightly confusing for people, but the bottom line is that people were able to build equity through their shared equity homes. Some families, many of them, their income changed while they lived there. Some of the homeowners got married, totally changing their household composition and their economic opportunity. But we looked at how much of it can we explain based just on the change in home equity. And so we said, we found that at the time that they bought, the average family invested about 2% of the market value of the home to purchase the shared equity home. At the time that they sold, their total equity represented an average of about 9% of the market value of the house. So even though they only received 25% of the growth in the market value of the house, they paid down on their mortgage over time, they made capital improvements, and they were able to gain ground relative to the market. So what that meant is that for half of the homeowners, even if they didn't get married, even if they didn't get promoted, even if they didn't change their relative income, half of the sellers would have been able to buy their same house on the market without any assistance at the time that they sold. And the others experienced some sort of change. And the important thing is that any one of these families could have remained renting during this period of time, and some of them would have increased their income or gotten married or whatever and been able to access home ownership as a result. But what we've done is we've lowered the hurdle. We've made the step from renting to owning much smaller, and we've made it easier for families to get over that barrier. Next. And so the last point is we did that without any additional public subsidy. Each time these homes turned over, the city, the state, the federal government didn't put new money in. It was available to another low-income family as affordable housing, but it was also available as an asset-building opportunity for that next family without any new subsidy. And these homes continue to offer that to families today, and will continue to do so tomorrow. And so what we found is that it's at least possible to generate life-altering wealth, to change people's outcomes, while at the same time preserving affordability. Balancing those two things is challenging, but it's at least possible. And that when we do that, we can offer a predictable way for people to build wealth, and there really aren't other predictable avenues for this kind of wealth building in our society. Just to transition now to Jeff Corey's presentation, I just want to mention that this work in Burlington has led to a broader study that NCB Capital Impact is undertaking with the Urban Institute, where we're looking at 7 programs, including Burlington, one of which will be the Northern Communities in Duluth. And so I'm going to turn it over to Jeff Corey, and he's going to tell you a little bit about his organization and how this works on the ground and some of the actual stories of real homeowners. Jeff?
Thanks, Rick. Again, I'm Jeff Corey, and I'm the director of Northern Communities Land Trust in Duluth, Minnesota. It's a pleasure to be on the call today. And I'm not certain exactly how the slide advancement will be working, so I'm hoping that it will be moving shortly. Great. Okay. Here's a photo of the Shabor family, one of the families that we've helped into homeownership. And below the picture of the family is our mission, creating affordable homes and strengthening communities through the wise stewardship of land and resources. The thing that I think our organization does that is something that shared equity homeownership isn't necessarily known for is we also do a lot of neighborhood stabilization work. We work in a lot of neighborhoods where an increase in homeownership ratio is something that would be good for the neighborhoods, and so we have a focus on that work as well. And we probably serve, in some ways, a lower income population as a result of that. Could you advance the slide, please? So a little bit about who the Land Trust in Duluth is. Like most land trusts, we're a 501c3 organization. We're a membership organization. Our homeowners have representation on our board of directors, and that's one of the ways that we remain accountable to our community. We were founded about 20 years ago, and land trusts do different things in different communities depending on what the needs are. We all work to preserve the affordability of homeownership and access to that homeownership by low-income folks, but depending on what other resources are in a community, land trusts do other things. In our particular community, our organization is a real estate developer, and as I said before, active in a lot of revitalization initiatives. We're also our own realtor, and we also have our own construction company, not because it's been fun, but because that's what our community needed in order for us to create the housing that the folks who buy our housing needs. So our mission, again, we provide affordable housing for low and moderate income people, and we do that in the Community Land Trust way, which preserves that affordability for future generations. Advance the slide, please. We serve qualified and income-eligible folks. We pride ourselves on doing really high-quality homes. One of the things about shared equity homeownership is that if you're building homes that you have an interest in maintaining the affordability of for perpetuity, the responsibility that you feel to create homes that are high quality and durable goes up considerably. In exchange, of course, for what our homeowners get when they buy one of our homes, they agree to pass that bargain price on. We talk a lot with our community and with the folks that buy our homes about paying it forward, this notion that they're getting more now than they're paying for, and they're doing so under the agreement that they're willing to pass that on to another similar household in the future. We use the 99-year renewable land lease as the tool to sort of covenant that agreement with the homeowners, and inside that lease is the resale formula, which determines what the price of the home will be at the time of sale. And our formula, like the one in Champlain Housing Trust, is an appraisal-based formula. You can advance the slide, please. That formula is proving to work in our community over the first 49 or so resales that we've done. We have about 190 homes in the trust today. We're very busy presently, so I say about because it depends on when the last closing happened. Our average buyers last year had about an income of around $30,000, which represents about 60% of our area median income. Historically, that's the percentage of median income that we've averaged over the last 12 years of work. And our folks last year had average purchase prices of about $88,000, and the corresponding average value of those homes was $131,000. I should note that that's a mix. About 2/3 of those homes were ones that we brought into the trust last year, primarily through acquisition and renovation and sale of homes. A lot of them vacant, blighted, foreclosed homes, and then 1/3 of those homes were resales that we did. Again, we've had 49 homes resell to date, and we've reused about $2.3 million in subsidies in the course of those resales. Advance the slide, please. I think that's one of the great things about what we do is that, securing those resources for the benefit of the community for the long term. Not often do we get a chance in our lifetimes to do work that lasts potentially beyond us, and this is one of those times on the affordability side of the housing. And one of the great things about the study of what does this mean in terms of wealth building is that we're learning now through the study, we being folks in the community land trust world, that the asset building, of course, will outlast us as well as generations benefit from these assets that they're able to accrue now. Again, we've had 49 homes resell to date, and all of them have resold to income-eligible buyers. And one of the key pieces, I think, not unlike what they've discovered with Champlain Housing Trust, is that about 80% of our sellers have moved on to market rate home ownership, which is a pretty successful ratio, we believe. And again, as in Champlain, the reasons for folks moving range from a lot of single parents or single folks that get married, to folks moving up in income, to folks moving elsewhere for work, and then, of course, the reasons that folks perhaps aren't as successful can range from similar things to, moving on from this life to foreclosure, or to deciding that the homeownership just isn't for them.
Jeff?
Urban Institute study that. Yes.
Oh, sorry to interrupt. Would you mind speaking up a little bit louder or directly into the phone or the microphone? We're having a little trouble hearing you through your connection.
Okay. My apologies.
That's a bit better.
The Urban Institute, is that better?
Better.
Is that better?
Yep, I can hear you more clearly now.
Great.
Thanks.
Yep. My apologies again. The Urban Institute study that Rick mentioned previously is bearing out that our homes are maintaining affordability and that our homeowners are building assets. And as we go to the next slides, we'll be able to see a couple of examples. This first one is an example of a home that was purchased with our buyer-initiated program back in 1999. At that point in time, the home had a market value of $64,000. We invested about $12,000 to lower the purchase price of this home to make it affordable to an eligible family. When we designed this home, interestingly, enough, at least to me. We were able to do it based in large part on my family's experience of buying a house the previous year, and I knew from that experience what the sort of equity push was that we needed, or the down payment push was that we needed to help folks get into a quality home. And so we had a lot of success for several years using our buyer-initiated program to get folks into homes affordably. If we fast forward to 2010, this home just resold a couple of weeks ago. It had, at that point in time, a market value of $112,000. And the community investment in the home, as evidenced by the gap between what the home was worth and what the next buyer had to pay, represented just over $33,000. At this point in time, the house had some need for improvements, not necessarily through the homeowners not taking care of it, but more we felt because we would have liked to have done more work to the house when we sold it initially than we were able to. And so we replaced the windows and the furnace, and as well the realtor commission was included in the resale price. So those were not expenses that come out of the seller's pocket. If you can advance the slide, we'll tell you a little more about the sellers. So when they bought the house, Michael and Shar had a son, Peter, who was 4 years old. Michael was working in the local food co-op as an assistant manager in the produce department, and Charlotte was working to get her degree, undergrad degree in social work. They both worked hard, were busy folks contributing positively to the community, but their 44% of area median income salary of just over $17,000 a year didn't allow them to be able to buy a house. Again, we helped them out with the Homeland grant of $12,000 and some rehab to do work to the home. And if you can advance the slide, please, we'll see where they were in 2010. They added Kylie to the family. She's now 6 years old. Michael has advanced to be the manager of the produce department. His salary has increased at least twofold since the time that they purchased the home. Shar finished her undergrad degree, also finished a master's degree, and is now employed by St. Louis County as a social worker and makes a good salary herself. Shar actually stopped by our office after the closing to say thank you. And it was interesting to me that what she was talking about wasn't just the equity they took out of the home, but she had a real clear realization that being in that affordable, stable homeownership situation allowed her to move on with her schooling. If they had not been in as affordable of a home ownership situation, she would not have been able to do all of the work associated with getting those degrees that you don't get paid for. So when they sold, they received about $23,000 at the time of the sale, and $13,800 of that was their share of the appreciation. $10,800 was how much they'd made on their principal, and then they had to pay about $1,000 in closing costs. So they represent a good example of a family that lived in a home for a significant amount of time in our market during the time when the market appreciated pretty significantly. If we fast forward, or please move the slide to the next example, you can see the person who bought their home Karen is a single person and employed as an administrative assistant. Her salary is about 64% of area median income, but interestingly, if you pretended for a moment she was a household of three, her AMI is about 50% and very close to the 44% that the Karshes had when they purchased their home. Karen's, of course, subsidy is bigger over what the Karshes received with the appreciation of the property, but about $33,000 is the value of the discounted price that she received. Fast forward the slide, please. So then the next example shows a family that bought a home in 2006 and sold the home in 2009. This family did not live in their home during a time of marked appreciation in our community. Our homes are holding their own in terms of value because homes under $120,000 in price are that are of high quality, haven't lost value significantly, thankfully, during the last few years, but neither have they gained any significant value. So this family's home moved up, and the flattening of the market here didn't really happen until 2008. So this family's house appreciated about $11,000 in value, and consequently, the community investment went up about $4,000 in value. As you can see, they paid $58,000 for their original purchase price, and then the next buyer will pay $65,000. So a little bit about the family. If we can fast forward this slide. Thank you. So this family, Rain and Chris and their son Miles, bought the house in 2006. Rain worked in a grocery store. Chris worked as a healthcare worker. Low-income folks, both of them working, and at about 57% of our area median income. They, interestingly, were participants in the local Community Action Agency's Individual Development Account program. We have a couple of great partnerships with that organization and work with folks both in an IDA program to purchase homes and also with an IDA program that does home repair work for our homeowners so they can save for making home repairs. Rain and Chris received the assistance of about a $23,000 subsidy to lower the price of their home and about $20,000 worth of rehab. And then if we move to the next slide, we'll see where they were at in 2009. Like the other family, their family had expanded some, which is another reason that our folks decided to move on. Rain was still employed with the same company, but making some more money. Chris was also likewise still employed, but they had moved up in their income. After 3 years of stable home ownership, their income had increased to $37,000, and they were able at that point in time to move into a bigger home. Their net profit was not a lot at the sale, as you can see, $2,800 roughly, but they did have a closing cost loan of $4,000 that they had to pay off with proceeds from the sale. We can move on to the next slide, please. The next buyer of the home, Kevin, was a single man. He's employed by an armored truck transport service company. His income, $23,000 a year, 55% for a household of one, and his value of the subsidy was $27,000. So my intention in sharing these examples is to sort of give a notion of what happens to real people who purchased shared equity home ownership when they move on to market rate home ownership afterwards. And I'm hopeful that clarifies the benefit from an asset building perspective of what our work has helped those families to do. And now I think it's time to open for questions. Not sure, but I
Great, Jeff.
Someone other than myself is moderating that part.
Yeah, no, that was excellent, and thanks. And just to note for everyone that the PowerPoints will be available on our website. There's an event page at the newamerica.net website. Let me, we've got a few questions to tee up. One of them was about the HUD's neighborhood stabilization program grants, and is shared equity compatible with these grant structures under the NSP program? Jeff Lubell, Rick, do you know the answer to that?
Yeah, I can answer that. Yes, the answer is yes. We have a number of NSP recipients that are doing shared equity home ownership, and NCB Capital Impact has a contract with HUD to provide technical assistance to NSP recipients that want to do it. So if whoever was asking that question wants to contact me, I can put you in touch with assistance. And I'm just posting in the chat the link to a report that we did last year that described the requirements in NSP and what the affordability mechanisms have to be and how shared equity fits into the rules for NSP.
Great. And here's a question for maybe you and also Jeff Corey, because I imagine it varies by project. But at resale, does the income model consider, one, the initial income level under which the family qualified, or two, the current income level of the family? Rick, Jeff Corey, how do you guys handle that in your model if it applies?
I'm not sure I'm not sure I understand the question completely.
I think it's.
So I'll give it a shot.
Can I try?
Sure.
I think it's a question about the income-based resale formula, and Jeff uses an appraisal-based. So in
Okay.
Duluth, what they do is the home price went up. They give the family 30% of the change in the appraised value of the home, so nothing to do with the ingoing or outgoing income of the homeowner. But what some other programs do that Jeff Lubell was mentioning earlier was tying the resale price to the change in the median income. And in that case, it's not the homeowner's income, it's the published area median income for the whole community. So when the area median income goes up by, his example was 15%, then the home price goes up by 15%. And what that should mean is that if a family at 60% of median was able to afford the house initially, then when it resells, a family at 60% of median should be able to afford it again, more or less. And so then the first family their income can be whatever it is. It doesn't have anything to do with their actual income.
And Jeff Corey, there was a question here about how you and your board evaluate applicants. Do families have priority over single applicants? Do people stay on the waiting list long? Is there turnover? And what might the average wait time be to get into a home?
It's a little bit of a complicated question to answer. Our work oftentimes ends up being more art than science, which is true, I think, for lots of things that we do in life. We have several applications always that are in process, and as a house comes onto the market, our process is that we list it publicly for 7 days before we will accept any offers for purchase of it. And at the end of 7 days, if there are 2 offers, or if beyond the 7 days we get 2 offers on the same day, then we have a selection policy that takes into consideration the incomes of the households, favoring, of course, lower income folks. It takes into account the size of the household and appropriateness for the size of the house, some of those sorts of things. What I can say is that those policies are good to have in the times that you need them, and it's been our experience, for whatever reason in our market, that we haven't had a lot of occasion to implement the policy. Typically, at the time that we've been ready to sign a purchase agreement, we've had one household standing there ready to buy.
Reed, did we have another question?
Yeah, sorry about that. I was muted myself. But this is about FHA, which has a record in the West of not approving shared equity models. And so there's been some problems with also on the conventional mortgage side. So what's been the experience with FHA for your programs? And maybe, Rick, you could mention broadly what your experience might have been, and Jeff Corey can talk about his experience in Duluth.
Yeah, we have the FHA has been a high priority issue for the Community Land Trust Network and the shared equity work at NCB Capital Impact as well. There are many of the shared equity programs across the country that have managed to use FHA. They have a policy that says that they will make mortgages available to buyers of these shared equity homes, whether they're ground lease, land trust projects, or deed restrictions. And yet the actual details of the policy make it difficult for many programs to access. And so we also have a number of programs that haven't been able to take advantage of FHA. We've been working with the staff at HUD to update the FHA policy, and they have been incredibly responsive. And we are very hopeful that they will propose a new policy that makes it much easier for these programs to access FHA in a more consistent manner across the country. If anyone wants more information about the specifics of what we're asking for and what's under consideration, please email me and I'll put you in the loop on that, because we'd particularly if you have a program and you're trying to get FHA, we'd love to make sure that the proposal addresses the concerns you might have found. I think it's worth also saying we have most of the major national mortgage lenders, largely thanks to Fannie Mae, have been willing to do these loans. It's a challenge in each community to sort of make sure the lenders understand the program requirements and et cetera, but we have pretty good infrastructure around the country of lenders that have gotten their heads around this different kind of home ownership, and Fannie Mae has issued some very clear and very helpful policies that make it easier, still not easy, but easier for lenders to do this kind of lending through and sell to Fannie Mae.
In Duluth,
Yep.
we've not been able to use FHA to date. We would love to. We've been active, as Rick has, in conversations with HUD, and had a very encouraging conversation with an undersecretary last week. So I'm hoping that it changes. It would be really good for our buyers if it did.
There was a question about getting your emails for people who want to follow up. Rick, maybe you could tap one in the chat section. But
we will also, I think, send up a follow-up email that will provide our contact information as well as a list of resources. We all have
excellent.
quite a lot of resources, and we want to make sure that you have access to a full list.
Great. Here's a question. I mean, we're at beyond the top of the hour. I think we can go get a few more questions in, and otherwise we can find other ways of keeping the conversation going, such as the follow-up email. But here was one about the appraisal-based model. How do you determine the percentage of equity shared to the purchaser in that model?
That's a good question for Jeff Corey.
Yeah, Rick helps folks figure this out all the time, so he probably has more wisdom to add. But what I can tell you from experience is that we've looked long and hard at our resale formula on a couple of occasions during my 12-year tenure here at the Land Trust in Duluth, and we haven't made terribly significant changes to it during those examinations. We're about to take another look at it this year. It's sort of like a 5-year physical or something. That's good for one to get. And how we picked it was, frankly, we were just experimenting with different percentages and different scenarios using spreadsheets over time for different things in the economy to change: wages, taxes, insurance, interest rates, all of the variables that can affect one's ability to afford a home. Changing as many of those variables as you can imagine and in as many combinations as you can think could happen, and running those out 10, 20, 30 years to see what would happen in terms of the affordability of the home. So, so far so good here in Duluth. Rick, you may have some things to add.
The only thing I would add is that there doesn't seem to be any magic right answer that makes sense everywhere. Someone asked a question in here about what if you have a depressed market and you don't expect appreciation. 20% or 30% of a rapidly appreciating home prices can be a lot of money, and 20 or 30% of flat market is nothing or next to nothing. And so we don't have one resale formula that makes sense in every community, and people have to go through a process with local stakeholders to think through, what's the right balance, and it does depend a little bit on what you expect to happen in your housing market. And we do that knowing full well that none of us have a crystal ball about what's going to happen in our housing markets, and whenever we think we do, we tend to be wrong. So what these programs do is they don't offer some perfect affordability or perfect balance. They offer a rough trade-off between a set of goals, and it's surprising to me that they do as good a job as they do. I mean, we found both in Duluth and in Burlington that the percentages that they chose resulted in pretty stable affordability, not dramatic increases in affordability and not dramatic losses in affordability, and it didn't have to turn out that way.
And the one thing that I would add to what Rick said, Jeff again, if as you're planning such things as resale formulas that you anticipate having work for very long periods of time, one has to be conservative, because we could always give someone more at the time of resale than we've promised to give them, but we couldn't give them less. if we have a contractual agreement to give them a certain amount. So that's the other thing, just as folks are thinking about what formula to use. It's better to be perhaps a little bit conservative and then generous at resale than to miss the mark.
Great. And here's a question about asset poverty level, especially that Rick raised. I'd like this question because maybe if there's not an answer, it definitely identifies where we'd like to do some more research and analysis. But if the asset poverty level at purchase, how does it compare, at sale? And is there any data available about the seller's asset poverty level, 1 year out from sale? And did they maintain the bump, or did it diminish over time? What do we know about that asset poverty level subsequent?
Yeah, that's a really fantastic question, and it is one of those things that we don't have data on and would be not that hard to get data on and really compelling and interesting. And so it would be a great follow-up research question. To some significant degree, people are apparently reinvesting that equity in purchasing other homes. And so the question is, what's their savings look like outside of the home equity? We know that people have some ability to draw on the home equity, but that it's also limited. So we don't really know how much having home equity, even at 200% or 300% of the asset poverty level, how much that achieves the same goals for the family as having that money in cash, and that's part of that question.
Great. Let's see. Maybe one or two more here before we sign off and we look for other ways to keep the conversation going. But this one is about maybe in Duluth, were all the homes new construction? In this other group that writes in, their first two were acquisition rehab, and they haven't done new construction. Are there pros and cons to this approach?
I think there's probably pros and cons to every approach.
Yeah.
The answer to what the homes were and are in Duluth is that it's a mix. The buyer-initiated program I referred to helped people buy existing homes on the market. We have, I think, about 90 of those homes in our program, and the rest of the homes are a mix of new construction homes and a mix of acquisition, renovation, and sale homes, which we're currently doing almost exclusively. And we're also a group that's been fortunate enough to receive a couple of infusions of the NSP funding. So advantages, a buyer-initiated program has the advantages of an organization not necessarily needing to conduct development activity to help people get into affordable housing. Disadvantages is you have less control over the quality of the home, perhaps, and you're buying existing homes, so their potential useful life may not be as long as if you're able to construct new homes. Disadvantages, of course, development of new housing takes a lot of expertise and resources and has inherent in it its own risks and complications. So I believe we've got to a point with our organization that most of the homes we want to bring into the trust now, we want to have a high degree over the control of the quality of them. But we're also to a point organizationally where we have the ability to do that.
Thanks. And maybe we'll take this as the final question, and thank everyone for their participation and time, and hope it's been insightful. And this is, in the asset building field, there's a lot of concern about predatory lending and the terms in which people end up refinancing their homes. Are there ways that the stewardship organization receives notification if a family refinances their loan? And if so, do they assist in evaluating the new loan to ensure that there's a net benefit to the homeowner? Or are there limits on their being able to refinance without the involvement of the sponsoring organization?
I can, as a practitioner, take a crack at that, and Rick may be able to speak to what happens more generally.
Great.
we only allow folks to borrow against the equity that they have in the home. So people's ability to refinance their home or to have a home equity loan or a home repair loan is limited by the equity that they have in the house based on what they paid down on their mortgage and what they brought in terms of down payment to the purchase of the home. So we have had folks make those loans, but the lease gives us, take out some of those loans, but the lease gives us the ability to say no when they're not able to actually have their own equity to borrow against.
Thanks. Rick, do you have anything to add in your experience?
Yeah, I think in addition to what Jeff was saying, it's a best practice but not a universal practice to also limit the type of loan product that people can use to either purchase or refinance. And most of these programs, in my sort of rough sense, will require that homeowners have a 30-year fixed-rate mortgage or at least prevent interest-only mortgages or high-cost mortgages. I think it's a real advantage of having a kind of a partner in the homeownership transaction that somebody can screen the mortgage product, but it's not something that everyone does, and some programs actually feel that it's entirely up to the homeowner to choose what mortgage product, and they rely on education rather than requirements to prevent predatory lending. But I think the result is roughly the same across these programs. The incidence of predatory products or exotic or high-cost mortgage products is very, very, very low. Most of the buyers go through pre-purchase counseling, and many, if not all, the programs limit the mortgage choice.
Thanks. Yeah, I mean, there's a couple more questions that have come in, and I think we're going to ask the panelists to look at them and see if we can include some addressing of them when we send out our follow-up note. But I wanted to thank everyone for their participation today, Jeff Corey, Jeff Lubell, and Rick Jacobus, and thank all of you for your time, and look forward to keeping the dialogue going down the road and exploring potential connections between the asset building framework and the shared equity homeownership model, which I do think holds a lot of promise. So thanks so much. Tune in for also an archived summary of today, and you can download the session or tell your friends about it as well on our website. So good day. Thanks for your time.
Thank you, Reed.
Thanks much, everybody.
Thank you.